Welcome to Private Markets 360, your insider's guide to the world of private investments. Today, we're thrilled to have Kurt Nye, CIO and Managing Partner at MAI Capital Management, on the show. Kurt helped grow MAI from a modest $2 billion boutique to roughly $70 billion in assets under management, expanding the team from about 50 to over 600 people along the way. Kurt will walk us through how private market investing is shifting from an institution-only club to a core piece of wealth client portfolios. Expect candid stories about the challenges of education, transparency, and setting realistic expectations, especially around the infamous J-curve and the role of secondaries in smoothing returns. If you're a wealth advisor or an investor curious about what really drives performance and how to think about risk, cash flow, and taxes in private assets, this conversation is packed with practical, down-to-earth insights. Kurt, welcome to Private Markets 360. It's great to have you with us. How are you doing?
I'm doing great, and thank you for having me here.
Well, thank you for joining us, Kurt. We're thrilled to have you on. So to kick things off, let's talk a bit about your career journey. You started at MAI as an intern, went institutional to Capital One and Townsend, and then came back. What did you learn on the institutional side that most change how you invest for the private wealth clients you have?
When I was at an institutional, so both at Capital One and at Townsend, this was during kind of the great financial crisis and in its immediate aftermath. And so that gave me a focus on how allocations work on the institutional side, how these very sophisticated, very large investors think about different asset classes. Maybe most importantly, it gave me a lens into some of the issues that arose from structures during the financial crisis, what worked well and was resilient in times of stress, and what faced issues. I also saw how institutional investors were able to negotiate economics and think about aligning incentives as they were making their substantial allocations. That directly applies now to what I'm doing at MAI in the private wealth world.
And as we think about MAI and its growth during your time there, from a few billion to tens of billions, that's a massive change. What was the biggest inflection point that enabled that kind of scale without breaking the investment process?
I'll speak solely to the investment side. So at MAI, one of the really important things we did is we developed a very structured asset allocation framework. It provides us a systematic way of looking at the entire investable universe, where we break everything out into 6 asset superclasses: cash, fixed income, equities, and then 3 different buckets of alternatives. So we have income alternatives, which tend to be your fixed income complements or replacement. Think things like private credit, which I realize is in the news a lot right now. Think things like triple net lease real estate, which is in some ways a private credit adjacent. We have growth alternatives, where you're still taking on equity beta risk. It just happens to be within private companies. Then real asset alternatives are those intended to help protect a portfolio against inflation. And these are the asset classes that have shown the ability to help do that over time. So think commercial real estate or infrastructure. Having those 6 asset classes then allows us to divide our investment team up into areas focused on sourcing best ideas across those different asset classes. Furthermore, then when it comes to portfolio construction, we put a framework together of guidelines about how much can be in any one investment, how much can be in any one asset class according to a client's IPS objective. And then overseeing that, we have a terrific team of people doing really rigorous underwriting. We're very fortunate that we see a number of opportunities every year, and our historical rate of approving something for a firm-wide investment has been actually under 1%. So we try to keep a very wide funnel to source as many possible opportunities as we can. I like to say that we don't believe anyone really has a monopoly on good ideas, and so we'll look at everything, but very few make it through all the way to being approved for client usage.
Let's talk about your clients a little bit. This is one of the important topics, I think, on education for wealth investors and really understanding what is an expectation in the institutional world. You hear a lot of talk about the J-curve, but it's not always fully understood. How do you set expectations around the early years experience for your clients, both emotionally and on the terms of performance?
We think about these alternative investments as, first, we want to be able to explain to our clients how the investment's actually going to generate its returns. what is generating the economics? Is it coming from a rent payment? Is it coming from the growth of a company that's providing an essential service? Where did the returns come from? That's a really important first step because, to your point, diving into the world of private investing, into the world of alternatives, you're going to deal with things like a lack of information. You might not see anything more than a quarterly report. If you have some kind of venture investment, it might not feel like it's doing a whole lot for many years. It doesn't mean that it's not ultimately going to be successful, but that feels very different than the immediate feedback that you're used to receiving in public markets. So first and foremost, understand how the investment is going to generate returns. Then understanding how it fits within a portfolio context. Why are you making this allocation? How does it help the client achieve their long-term financial goals? We try to avoid, we don't want to do alternatives just to say, okay, we've done an alternative in a portfolio, right? There should be a very specific reason. And then you need to educate the client before making the investment. What does that client experience feel like? Is there a J curve? Meaning that at the beginning, the sponsor is going to be charging fees when relatively little capital has been drawn, and it's going to be reported as negative returns. How long is it going to be illiquid for? Will there be intermediate realizations, or is it all kind of a lump sum at the end? Even things like the timing of K1s and the complexity of K1s are items that are really important to make sure someone understands, especially their first alternative investment. When we talk through the risk side with clients, we want to make sure people understand in what scenarios does the investment underperform. Our view is that risk is not necessarily a bad thing. You want to be very educated about the risk that you're taking, though, and you don't want to give the impression that something is low risk when it actually ends up being high risk. I think that kind of mismatch in expectation is where issues really occur. And if we step back and we say, okay, for this group, what kind of investments typically resonate? We found that investments that produce cash flow tend to resonate a little bit more just because you see that kind of more immediate outcome from that investment, whether that's real estate where you're getting the rental payment or something like private credit where you're receiving a loan payment, even infrastructure where you're receiving the operating payments. Those tend to be easier to understand, easier to view within a portfolio context than something like seed stage venture, where you might be looking at a 10 to 15 year, sometimes longer payoff.
It's a great point. We spend a lot of time thinking about how wealth investors will, deal with understanding the J curve, liquidity, expectations, and those things. But you're also pointing to a lot of important insights, between the asset classes or sub-asset classes themselves. Loss ratio expectations within venture being much different than where they would be in mega buyout. A lot of things to get your clients comfortable with. When you think about your experience on the institutional side versus the wealth side, are there other observations of material differences in the expectations of clients and maybe where some of those gaps are closing as we see more wealth participation in private markets?
With some of my institutional clients that I was working with, their portfolios were so incredibly large that they would look for the nth degree of diversification. And what I mean by that is they would have a roster sometimes of north of 20 buyout managers. For most high net worth investors, most private wealth investors, the idea of having allocations to 20 different private equity funds doesn't make a whole lot of sense, nor is it really economically feasible based on kind of minimum requirements. So you need to step back and look at what are the constraints imposed by the portfolio size? What is an achievable level of diversification? How does that impact overall sizing? Second, you need to think through the tax nature of what you're doing. If you're investing via qualified funds, like that might be one thing that you can run into UBTI issues sometimes with that. So you need to make sure your blockers and whatnot. But for a taxable investor, you need to think through what does this investment do from an after-tax perspective? A lot of the institutional investors are in a very privileged position where they don't need to take tax impact into account. Third, thinking through characteristics of investments that might resonate more on the high net worth side, or the private wealth side. One of the ones I mentioned earlier is this focus on cash flow. especially when we have our whole bucket of income-oriented alternatives where we're trying to solve some kind of income need and use them as a complement or replacement to fixed income, that cash flow becomes very important. For an institution, that cash flow might just be reinvested. It might not be going to help fund ongoing living needs. So a little bit of a different mindset there. In terms of the reporting, the private wealth channel is going to want to understand in plain English how things are going. Is it going well? Is the investment meeting its original objectives? On the institutional side, I see a lot more focus on benchmarks. How is my private fund doing relative to, pick your data aggregator, benchmark, and then how is my overall institutional portfolio doing relative to my peers? Again, private wealth side, it's much more, how's my portfolio doing relative to my goals and objectives? Performance versus peers, less important. So those are the big differences that I see. Some asset classes, you need to think through what those differences mean in terms of implementation. As one example, a number of infrastructure funds that I've seen over time, I have incredibly long lives, right? Sometimes 15, 20-year terms. That might make sense for an institution. That can be a lot harder for many private wealth clients to have an allocation to something that's going to last 15 or 20 years as a single allocation.
That does seem like quite a time horizon, especially to some people that might be a little more focused on more short-term investing and also more familiarity with more liquid investments that you can trade in and trade out of versus taking that long-term approach. So, Kurt, the differences that you highlighted, there's cash flow expectations, transparency, and how risk is framed. They often become most visible when wealth investors are newer to private markets. And that leads directly to the question of what needs to be reset earliest in the conversations that you're having with newer investors. So I'm curious, when you talk to a high net worth investor that's looking to invest in private markets for the time, what's the first misconception that you try and clear up? Is it performance, liquidity, or risk?
All of the above. So when I'm talking to a high net worth investor, they're thinking of making their first investment to an alternative in private markets. We want to make sure that they understand things like, well, what's the expected liquidity versus what's the maximum contractual liquidity? What happens if you hit the maximum firm on a fund? And all three of those, that performance, liquidity, and risk, are all kind of tied together in terms of that investment experience. In terms of risk, we're very downside focused, which might not be as fun as talking about the potential upside if everything works out. But we want clients to understand, well, what happens if this investment underperforms? What risks could cause this, in some cases, to go all the way to zero, right? Where are those sensitivities? And are we achieving adequate returns for the risk that we're taking? And when we talk about risk in private markets, one of the misconceptions that I see is that people will use things like a standard deviation based on quarterly marks or annual marks to represent the underlying risk of an investment. And that's one where you really need to think about unsmoothing that standard deviation to more appropriately capture the economic risk of the investment. And if you don't, what ends up happening is you're going to report risk-adjusted return statistics that are overinflated. So that's where you're going to see these spectacularly high Sharpe ratios. You're going to think, wow, I can't lose on this investment. And then you're going to set up expectations that don't tie to reality. And that's where people can get into trouble. So you want to lock in and first understand what are the economic return drivers, and then tie that performance, liquidity, and risk all together into what that client experience should feel like. On the performance side, when we think about reporting on private portfolios, we're going to report time-weighted returns, which we think are economically meaningful at a portfolio level. But then when we're examining individual investments, we're also going to take a look at and multiples. And the reason that we do that is we want to either penalize or reward a manager for the amount of time that they're holding our capital in the strategy. So that's the IRR metric, which does that. And then the multiple gives us a sense of how economically meaningful was this total investment, because you can have an investment that has a very high IRR, but if the capital is only at work for a short period of time, the multiple is not going to be economically meaningful. That also plays into the client experience, where you need to make sure your clients understand, is the sponsor using something like a credit line, which can have a large impact on the IRR.
So you spent some time there talking about the need to explain downside risk and potential obligations in alts investing. Can you give us an example of what a hidden or underappreciated obligation is that investors should understand before they commit to private strategies?
When we're thinking about risks and some that might be hidden, it's important to think through how the potential investment structure, given the underlying liquidity of an asset that's going into the structure, and to be more specific around that. The traditional way of accessing private markets has been a drawdown style fund, where you pay capital calls as investments are sourced, and then as the portfolio is sold, proceeds are sent back to you. Certainly over the last 10 years, we've seen a significant increase in the number of semi-liquid vehicles that are available to access various asset classes. We've seen them available, for instance, in private real estate, private credit, you've even seen private equity. And those vehicles, that label, that semi-liquid label is really interesting to dig into a little, because those vehicles will offer a liquidity option, typically quarterly. And then depending on the structure, it might be a guaranteed liquidity amount, or it might be subject to the approval of the board. That's a very important distinction, right? Is it actually going to be there, or can the board revoke that amount of liquidity? And then the second piece of that, and what we've seen in a lot of headlines recently in private credit, is that semi-liquid structure can be gated, meaning that you can ask for your money back, but you're not going to receive 100% of what you asked if everyone else asks for their money back too. And if enough people ask for your money back, that gating can be pretty severe. When that happens, you kind of run into this game theory scenario. Think back to your econ 101 and think back to that prisoner's dilemma type game theory, where you have two people and they can each kind of rat each other out, but that's kind of the optimal game theory strategy. When it comes to the gates on these semi-liquid vehicles, you might have confidence in the underlying portfolio, but you might expect your fellow investors to want to redeem, and then the manager might be forced to sell assets, might be forced to lever up. In any case, you would say, okay, my optimal approach then is to also gate. So it adds this element, all of a sudden the structure adds this element of additional consideration, where you're underwriting not only the investment merits, but you're also having to underwrite what are the implications of the structure, and what does this feel like in a bad environment? Why I said this as an answer to your question around hidden risks is I've heard from a number of investors who thought, well, I'm going into the semi-liquid structure. If I want liquidity, I ask for it and I receive it back. And that's a partial truth, right? That's true if you have some kind of idiosyncratic liquidity need. If you need liquidity and no one else does, you're going to receive 100% of your money back. That's wonderful. However, in times of stress, when liquidity is most precious, you're likely to be gated.
Really good points that you bring up, especially thinking about how the different structures, how they work in practice. I think it is important also to realize that timing of when people are asking to redeem, because it's also another key theme that you brought up. It's not just, what one investor wants to do. You have to also think about in the context of a downside scenario where it's more market driven that everybody might be wanting to redeem around the same time, given, something that happens in the economy, for example. And switching gears, Kurt, I want to talk a little bit about defining success as well. So, once investors understand that alternatives come with embedded obligations, not just returns, it reframes how success should be defined up front. And that same discipline around downside awareness and commitment structure also shows up in how managers decide what to invest in the first place. And you mentioned that your acceptance rate is extremely selective, I believe under 1%. Could you please share the top maybe two or three reasons that you say no, even when a fund or deal looks popular in the market?
Sure. And it's an interesting question that you're asking because popularity doesn't necessarily result in a good investment outcome. If a lot of people all are chasing the same idea or a lot of capital is chasing the same space, that would often imply lower expected returns. When we're looking at things that may be popular in the market, a very common reason for saying no is that we see groups that have terrific mark to market performance or mark to model performance, but they haven't realized many investments on behalf of their investors. So you could think about that exact scenario where you're invested in a particular need, a lot of capital is flowing in, valuations are rising, you're marking your portfolio to the latest fundraise, and the on paper performance looks wonderful. But again, if you haven't actually sent capital back to your investors and sent cash back to your investors, we're going to heavily discount that performance. Another reason that we see for that is we have a strong preference for investing in teams that have been through a market cycle. We're not able to forecast that we're going to have a recession in 12 months or 24 months, but the odds, if we're doing some kind of long-term investment, some kind of 8 to 10-year investment of having an economic downturn during that time frame are relatively high. And we like the idea of allocating to a team that has been through some kind of economic distress and been able to work really hard on behalf of their investors to deliver the best possible outcome that they can. And so those are two pretty common reasons for us to say no, even if something isn't in a popular area or even if there is interest. And last, I would just say that we track each of the opportunities as they come in and we'll classify them. And it is interesting to see over time, there will be waves of particular themes that come across where all of a sudden you're seeing a lot of consumer deals or you're seeing a lot of real estate deals or a lot of venture as it becomes the investment topic du jour.
Staying on that line, you said no one has a monopoly on good ideas. You've also noted in other conversations that some of the best opportunities you've seen can come from a client's quote unquote random idea or their professional network. And then you run it through your top down and bottom up process. Can you take us through an example of a time that happened and what made it work?
Sure. We're in a great position to have just terrific clients, and it's truly a privilege to serve them. And when we see ideas coming in, just based on our pass rate that we were talking about, the vast majority are going to be a no. And certainly we'll run institutional or consultant style search processes where we say, let's go find the best XYZ manager in an area. But to your point, some of our best ideas have come from client referrals where a client says, hey, I found this interesting opportunity. Can you please take a look at it and vet it for me? And that's led to some really impactful relationships. I'll give you one example on the real asset side. This is about 15 years ago now. We were presented an opportunity, a client was presented an opportunity to do a co-investment into a single asset. This asset was basically responsible for managing the power grid in a pretty large region. The company had a terrific credit rating. The valuation was very attractive. And you have these contractual built-in escalators that provided what we believed was just a really interesting risk-adjusted return. So we were able to underwrite this to 12 to 14 net return driven by essentially single A type credit risk. And so we did all the work on it. We actually went through kind of the full process of doing background checks on the principals involved, of renegotiating all the legal documents, and ultimately that our client took his share of that co-investment capacity. But we thought it was such an interesting opportunity that we're actually able to bring it across our client base. And that led to a number of subsequent ventures with that same manager. And it proved to be a very fruitful relationship for our clients.
That's a great example of a client-sourced idea. And also interesting because the process matters as much as the access. Like, you were able to get the access, but then you were able to also really vet it to make sure that it was a sound investment based on your underwriting criteria, which clearly the client was really relying on you and your expertise, your team to help them with that assessment. So once an investment clears that underwriting discipline, the next layer of rigor, especially for wealth clients, is how it fits into a portfolio and they take into consideration the fees and the taxes. And Kurt, I'm sure that taxes are an area that matter a lot for your client base, especially those that are based in high tax states. How do you incorporate after-tax thinking into private market selection, structure, turnover, UBTI considerations, or anything else?
It's so important for our investors to understand the tax implications of what they're doing beforehand. And just in structurally in general, I want to make the point before diving into tax that in every investment we're doing, we're going to absolutely try to negotiate and often are successful in negotiating better economics for our clients. So we're going to try to use our institutional scale that we've achieved to drive an economic advantage for our clients investing through us. And we really view that as structural alpha. Jumping into the tax piece, tax efficiency is so important. And when you think about headline returns, there's a very large difference between a 10% return generated as ordinary income and a 10% return generated as long-term capital gains. And so thinking about asset location, thinking about tax impact, thinking honestly, even about in estate versus out of estate taxes and what did certain decisions do to my ultimate estate tax, as well as thinking through, well, if I'm going to use qualified funds, I need to be thoughtful around UBTI considerations or making sure that the underlying investment has some kind of blocker structure in place is important. We're seeing more and more alternatives being used through things like private placement life insurance, which allows you to take what would typically be a very tax inefficient investment and make it much more tax efficient through that kind of insurance wrapper. But there are certainly considerations around that and kind of some size restrictions that are important. And so taxes are not the main driver, but taxes can absolutely be an issue where you'd say, look, I'd love to make an allocation to this investment, but it's just simply after tax, it just doesn't make sense. I think that the good news when it comes to taxes is not only other things like private placement life insurance, but later this year, we'll see a refresh of things like the opportunity zone guidelines. There's ways to really help taxable investors when they're looking at 1031 exchanges with a number of groups that have the 1031 to 721 structure set up. And then even in combination now with things like active trader funds or the long short direct indexing strategies, where you can essentially, in the first case, potentially generate ordinary losses against income that could be generated by some of your other alternative investments, or generate capital losses that could be used to offset capital gains generated by some of your alternative investments. there's a lot of really interesting happening at the intersection of investments and tax planning going on right now.
And I think to round out this conversation, we'd like to look ahead a little bit. As you think about the next 3 to 5 years, what do you think will define best-in-class private markets programs for wealth? From product design to reporting and transparency, liquidity solutions, and advisor capability, what are the factors that matter most, and where do you see this going over time?
I think to be an effective part of private wealth portfolios, alternative investments or private investments need to be thought from a very strategic perspective. So thinking about that over the next 3 to 5 years, I think the programs that fare best are going to be those that have set strategic targets for their clients, who are reporting the ongoing progress towards achieving those targets. And what kind of targets am I talking about? I'm talking about hitting target allocations. I'm talking about hitting kind of target performance, although I would also suggest that 3 to 5 years is unfortunately a short horizon to measure performance in some of these, but you can certainly see how they're doing at that point in time. I think being diversified by vintages is very important. Taking that role, I'm not sure if this is going to be the best performing vintage or kind of worst performing vintage or somewhere in between. So I need to have diversification across vintages or the years that I'm investing in is really important. And as important as it is the selection of how you're going to do those investments in the strategic case, I think the ones that do it best also have a plan for the entire portfolio and what are the dollars that are committed doing before they've been invested. If you've committed to a private equity fund and it's going to be called over 5 years, are you keeping that in cash? Is that part of your diversified asset allocation, right? What is your approach for doing that? And how do you communicate that overall to your clients? We also believe that trying to find opportunities to add alpha in private markets will help make certain programs more successful. And I would expect that those alpha opportunities are going to be in potentially like the less traveled roads. So we were talking earlier about popular investments. I would expect some of the alpha opportunities to come up in the less popular areas where you don't have as much capital chasing them. And those are going to help distinguish your private investments program. If everyone can allocate to the same thing by just clicking the button, it's not going to be very differentiated. And finally, it's really important for advisors to be able to communicate the why to their clients. Why am I investing in these? Why am I taking on the illiquidity and the tax complexity? And how does this fit in? And how does it benefit my financial plan? The advisors that can clearly articulate that are going to be the ones whose clients are able to have the wherewithal to hang on to hit those strategic targets. And those are going to be the ones that experience, I think, the best long-term financial outcomes.
Thank you for joining us for this episode of Private Markets 360 with Kurt Nye, CIO and Managing Partner at MAI Capital Management. Kurt explained how private market investing is becoming a key part of wealth portfolios, stressing the need for disciplined process, education, and transparency. He covered the J-curve, risk and cash flow expectations, and why a rigorous top-down and bottom-up underwriting framework is non-negotiable, even when an idea comes from a client's network. We also heard why MAI's sub 1% acceptance rate is a guardrail and how after-tax considerations shape product selection and what will define best-in-class private market programs over the next 3 to 5 years. If you found today's conversation valuable, please subscribe, share the episode with colleagues, and stay tuned for more deep dives into the evolving world of private markets. Thank you, and until next time.